Richard Donchian's channel is the simplest trend tool ever published, and yet the original turtle traders used it to print nine-figure profits. Today, we dissect why a 55-day high still matters, where it fails, and how to layer it with volatility and trend filters so you stop getting chopped up by every fake breakout. The math is trivial. Upper channel equals the highest high of the last n bars. Lower channel equals the lowest low of the last n bars. The middle line is the average of those two, which is not a moving average. It is the midpoint of the recent range. That distinction matters. Donchian tracks extremes, not means, so it reacts to outliers rather than smoothing them. Price riding the upper band signals dominant buyers. Riding the lower band signals dominant sellers. A flat upper band while price pulls back tells you the prior high is unchallenged. Energy is leaking. The middle line acts as a dynamic equilibrium. In healthy trends, pullbacks stall near it. When price slices through the midline with conviction, the trend is in question. Turtle System 1. Enter long when price closes above the 20-day high, exit when it closes below the 10-day low. Short is the mirror. Critically, the turtles skipped a signal if the previous theoretical breakout would have been profitable to avoid clustered false breaks. System 2 used a 55-day entry and 20-day exit for slower, more reliable trends. The turtle edge was not the breakout, it was the sizing. They defined one unit as the dollar risk equal to 1% of equity divided by the average true range. Wider ATR meant smaller position, narrower ATR meant larger. This normalizes risk across markets, so a quiet bond breakout and a wild oil breakout cost you the same if wrong. Initial stops at 2 ATRs below entry. Winners were pyramided. Add another unit every half ATR of favorable movement, up to 4 units, with the stop trailed to 2 ATRs below the most recent add. The result is asymmetric. Small losses, occasionally enormous wins. That positive skew is what carried the strategy through years of choppy underperformance. Watch this idealized chart. Price consolidates, then closes above the upper band. That is your entry trigger. Stop goes 2 ATRs beneath. As price walks up the upper band, you scale in. When price finally closes below the 10-day lower band, you flatten everything. Notice the exit lags the peak. That lag is the cost of catching the whole move. Here is Apple on a daily chart over the past year. Mark every 20-day breakout and every 10-day reverse break. You will see clean, multi-week trends captured in full, alongside 2 or 3 painful whipsaws where price broke out and immediately reversed. Count both. The strategy's expectancy depends on the winners being far larger than these losers, not on being right often. Donchian's weakness is obvious in sideways markets. In a tight range, the bands compress, and every minor pop triggers a false breakout. You buy the high, get stopped at the low, sell the low, get stopped at the high. This is the standard trend followers bleed. The fix is not to abandon the system, it is to require an external regime filter before taking the trade. The simplest filter is ADX. Require ADX above 25 before accepting a Donchian breakout, and your false signal rate drops sharply because you are only trading when something is already trending. You can also use a long moving average. For example, only take longs when price is above the 200-day. Both filters trade some early entries for far better signal quality. Confirm breakouts with volume expansion. On-balance volume making a new high alongside price is a strong tell. Also watch ATR. A breakout into rising ATR signals fresh participation, while a breakout into falling ATR often fails. And keep an eye on band width itself. The tightest Donchian compressions before a break tend to produce the cleanest follow-through, similar in spirit to a Bollinger squeeze. 3 pitfalls kill traders here. First, using intraday touches instead of closes, wicks lie. Second, choosing too short a look back like 10 bars on a noisy market, which guarantees whipsaws. Third, abandoning the system after a string of losses. Trend following wins through skew, and skew requires that you take every signal that passes your filters. Skipping the painful ones means missing the outlier that pays for the year. Tomorrow, pull up your watch list with 20-day and 55-day Donchian channels, ADX, and Adder. Mark instruments where bands have compressed and ADX is rising. Pre-plan entries at the upper band, 2 ATR stops, and 10-day band exits. Size every position by ATR so risk is uniform. Journal each signal, win or lose. This is education, not financial advice. Test before you trade live. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.